Welcome back to Small Caps, ladies and gentlemen. My name is Kerry Stevens, and today I'm bringing you Kevin Wadsworth. He's co-founder of North Star Bad Charts. We're going to talk about charts. We're going to talk about technical analysis, and Kevin's background's in weather forecasting. Boy, do we need him down here at the moment, because the weather down here at the moment, Kevin, is crazy. Kevin's coming to us today from the UK, where it's freezing cold. Down here, it's really hot. And the weather's all over the place. But we're not talking weather today. We're going to talk about what is going on with these markets. There's a lot of confusion at the moment, Kevin. People are saying, do I go all into the markets? Do I sit back and wait? It's a rocky road out there. 500 points up, 500 points down. Where are we going? So welcome to Small Caps. Great to see you, and I really appreciate your time.
Thank you, Kay. Thanks for the introduction there. It's great to speak to you. I've been looking forward to this conversation, and we've got quite a few charts to get through. I'm going to try and keep it nice and light and nice and straightforward, so that the audience can hopefully make sense of what I'm trying to say. I know a lot of people get a little bit scared when you talk about technical charts and technical analysis, but one thing I learned in the world of weather forecasting, you can have a whole load of great science in your head here, and you can walk in front of your audience, and it doesn't matter how much good science and evidence you've got. If you can't present it in a way that people can understand it, then you might as well be talking a foreign language. So I'll try and say what I've got to say in a way that everybody can hopefully understand it.
Well, if I understand it, everybody can understand it, Kevin. So let's get started. Have you got an overview, if you like, of where we're at the moment? Because I get lots of conversations from people who just don't know what's going on. Are we headed into a recession? Are the bad times behind us, or what's going on in them? And why? I guess the other thing is, how do the charts tell you and predict what's going on?
Yeah, okay. Well, I can try and explain that, Kerry, with this first chart that I've got to show you. Hopefully, you can see my screen.
Yep.
Can you see my screen? Just double check before I start talking. So what you're looking at there is the 10-year yield. This is the US 10-year yield chart. And to answer your question directly, how can the charts help us at all? Well, if you look back at the left-hand side of that chart in the 1960s and 70s, you can see the 10-year yield, the interest rates in the United States, the yield on the US government debt was rising. And as it rose through the 60s and 70s, it was supported by a rising support line. You can see very clearly that the trend was up. And then it peaked, it went off into a blow-off top, and then that trend line was broken. In fact, a couple of trend lines were broken, the first steep one and the second one, which wasn't quite as steep. Now, what you can clearly see, even if you're not a technical chart analyst, is that we changed. We changed from an era where the chart was rising and it was being supported by a support line to a 40-year period where the chart was falling away and the graph was dropping down and down and down and down and down, and it was being supported by a support line. And it was every time that yield tried to rise, it got pushed back, and it got pushed back by that resistance line that's marked on there. Now, if you just pause for a second and think about this, people talk about fundamentals and they talk about technical analysis as if they're two separate things. They're not two separate things at all. Fundamentals and technical analysis are joined at the hip. But try and think of it this way: the technical analysis, these charts, what they're telling you at any point in time is everything that is known about the fundamentals. So that if you're to look at the gold price chart today, it's not some kind of voodoo trying to draw lines on the chart that's kind of making stuff up. What you're doing is you're actually taking note of the price chart that is basically the sum of everything that everybody knows. I mean, I don't know all the fundamentals. You don't know all the fundamentals. We can try. We can talk to lots of people, get lots of views and opinions. But do we ever really know all the fundamentals about every company that we happen to talk about? Of course we don't. We don't know what's going on behind the scenes. A lot of the stuff is hidden from us, even if we think we know the fundamentals. So, but the price chart, it's representing everybody that's got an interest in that company or that investment vehicle. It's all summed up in that price chart. And in this 10-year yield, it's going down and down and down. And why was it going down? Well, think what was happening during that 40-year period in the United States. Money was being printed at an ever-increasing rate. The debt of the United States was rising 10 trillion, 15 trillion, 20 trillion, 30 trillion. And just pause for a moment. What does that mean? Well, what it means is that each time the United States tries to put up interest rates to control a little outbreak of inflation, you'll reach a certain point and it starts to cause pain. Don't need to define here what I mean by pain, but it starts to cause problems in the broader economy, trying to raise interest rates. When you have an increasing pile of debt, clearly the debt serviceability for starters starts to become an issue, because just the interest on that debt takes a larger and larger proportion of your GDP, and that's where the pain begins. You know, if you've got less money to do the things that you need to do in an economy, if I can get my words out, that's sounded easy to say in my head. If you've got a smaller amount of money because you're just simply paying off your or servicing your debt, then that is going to cause issues in the broader economy. So each time the yield was wanting to rise above that line, it got pushed back. So one thing that I knew, sort of sitting back and looking at that, was that if yields ever broke out above that resistance line, then it's going to be telling us something quite important, or very important, was happening, and it's also going to cause pain in the broader economy. And of course, when that happened several months ago and the yields broke out, then all sorts of stuff started to reverberate through the broader economy, not just in the United States, but globally. And it's no coincidence that all of these problems that we've seen over the last year or so in particular have occurred in tandem with this chart breaking out to the upside. And also notice that before I move on, notice that we are now in an era very similar to the 1960s and 70s, where that yield chart is now accelerating off to the upper right, and it's being guided in that direction by a support line. Now, you might just say these are arbitrary lines on a chart, but they're not. They're support and resistance lines, and these aren't lines that come out of nowhere. They're developed through price action, and the algorithms and traders and everybody that has an interest in this chart, they know where these levels are. So the buying and the selling is what creates these levels in the first place. So it's kind of almost like a self-fulfilling prophecy, if you like. So
let me just ask you this, Kevin, if I could, because it's fascinating. This quite often, I think we look at a more of a short term, like this is 1960s going out to 2030, which I find fascinating. But it's interesting to look at this now and to say since the mid-80s, we've actually been breaking down and having pain until 2019. That's what this is showing us. So what you're saying is that almost it sounds like we're off to the races. Is that what I'm seeing?
So the dynamics that are at play now that have been unleashed by the breakout on this chart, even if the 10-year yield comes back to about 2.3 or 2.4%, and no doubt if it was to do that, people would be saying, oh, problem's over. To me, as a technical chart analyst, all that would be doing is backtesting the breakout. So it's broken out. Very often after a breakout, the price action of a stock or a share or whatever it is comes back and back tests the breakout. It's the market reconfirming the significance of that breakout. So as a technical analyst, the probabilities are very strongly in favor of a developing trend over the next 5, 10, 15 years, where this yield chart moves to the upside. We're in a different paradigm here. So the rules that governed the last 40 years do not apply in the same way. So the relationships and the correlations that have occurred over the last 40 years that traders have become accustomed to since the 1980s are now not applicable, because we're in this kind of new regime. I'll just show you something else, Kerry. This is moving on to look at the this is German baseload power. So also, what I'm trying to do here is just paint a sort of a view of what's going on in the big picture before we sort of drill down and look at some more specific charts. But this is an example of what's been going on in Europe, for example. One of the world's largest sort of trading zones, the Eurozone, and Germany, of course, being the sort of powerhouse of that bloc, and sort of payrolling or bankrolling to a large extent the European Union. Now, this is German power baseload. So energy costs we're talking about here.
Okay.
And you can see the energy costs on this chart. I'm just going to glance down to my left-hand side because I've got a larger screen here. I can actually see the numbers on it. Around about 50, 55, 60 euros per unit on this German power baseload. It's kind of what's the historical kind of norm for the levels to push up to when they reach particularly high levels. Well, we pushed beyond that, went up to 60, 70, 80, 100, 200, 300, 400, 450. I mean, these numbers, it's the sort of progression that you would expect in some kind of cryptocurrency meme coin or something. But we're talking about energy costs for the core of the European Union here. And from a technical chart analyst point of view, what's significant here is the support and the resistance line. This is a broadening, expanding wedge. Okay, they are patterns that break to the downside eventually because of their increasing instability. As the wedge broadens out, price action oscillates between the lower and the upper support and resistance line. But because they're diverging, it means that you're getting unsustainable sort of volatility and unsustainable moves, and they resolve to the downside at some point. So at some point in that area of shaded green, you would expect this chart to break down and the base load power costs to come down. But the question being just how high it gets in the meantime, and that red shaded zone, if we ever get anywhere near there, that'll be disastrous, because you're talking about levels above 1,000 euros per unit, bearing in mind that the historical norm is somewhere down around 40, 50, 60. So up at those kind of levels, you'd be talking about some kind of systemic real systemic issues. Of course, that has fed into the producer price index, the PPI for Germany. And many months ago, in fact last year, I was showing this chart and pointing out that what's happening at the moment, and I keep sort of hammering this home to people, it's not your usual run-of-the-mill type of event. The producer price index in Germany was very high in the 1970s. It almost got as high as it was when Germany was recovering from the terrible after effects of World War II. But look where it's just been. I mean, yes, it's retraced to some extent, but look, we've been month after month after month after month up at these levels above where they were in the 1970s and even above where they were post-World War II. So these ramifications, they're not transitory. What's happened is that it's lingered up there long enough that these producer price costs have been passed on to consumer prices indices. So the consumer prices and inflation has been picking up on all of this. So this is why the problems and
part of the issues that we're seeing. Kevin, sorry to interrupt you. Why Germany?
Yeah.
Why are the German charts important? Because you showed us German baseload power, and now we're getting into the PPI.
Yeah, I mean, I could equally have picked Italy, Spain, Portugal, the UK. They all look very, very similar. Okay. The reason I picked Germany is just because of its importance in terms of, as I say, sort of bankrolling the European Union. We all know during the financial crisis that Germany was key to the sort of bailouts that took place of the weaker peripheral economies in the European Union. Greece, for example, when the country's banking system needed bailing out. So, and all of that was made possible by, as I say, the European Central Bank and in particular the German economy. So Germany is key and very, very important to the finances of the European Union. But as I say, I could have picked Italy, Spain, Portugal. It wouldn't really have mattered. They all look very similar. But also the German PPI chart here does go back further than some of the others on the data that I have available. It just so happens that the German data goes back to World War II. Right. So it helps to put it into a very long historical sort of context. So, and the reason for showing this is just to sort of try and jolt people into this sort of realization that, oh, hang on a minute, what's happening now? It's not like what happened in, 2008. It's not the same as that. It's not the same as the dot-com bubble. It's not this. What we're seeing now is something that is quite unique and a very worrying set of circumstances. And here in the UK, we're starting to see this spiral of inflation leading to huge wage demands. And once you get this wage price inflation spiral, that's, I think, what politicians are particularly sort of worried about. And we've got strikes. We've got the ambulances are on strike. The rail workers are on strike. We've got nurses on strike, doctors, teachers. They're all going out on strike because they want sort of inflation matching pay rises of 10 or 11%. Of course, that's government's offering 3 or 4%. So hence all the strikes. So we're getting into that sort of 1970s style. I suppose you could sort of stagflationary almost. Kind of wage price spiral issues, and it tends to be a monster that feeds on itself from that point onwards. if it had been transitory, then it wouldn't have been so much of an issue. These effects wouldn't have had a proper chance to sort of pass on to consumer prices and therefore to inflation and to wage demands.
And Kevin, is that sort of issue? Do you see that as being global and not just, we're talking Europe at the moment, UK, but are you seeing that this is a global crisis or confined to a European issue? Because we've got inflation down here in Australia, we've got it in the US. But what I guess the question I'm asking is, where we're headed, is it the same globally?
I suspect it probably is. I mean, in the United States, the inflation levels haven't reached the dizzying heights of 10 to 15%, which they have across many European member states. I think in the United States, where last I looked at, was it 7 or 8%, something like that. So the numbers have been more sort of contained to an extent, but I have a strong suspicion that we're going to see this progress in a series of waves of inflationary pressures. So I suspect that the current receding of inflationary pressures is going to prove to be somewhat sort of transitory. But the technical charts will give us plenty of warning of the next wave coming, sort of crashing in our direction. Certainly here in the European Union and in the UK here, we are just pulling back a little bit from the recent highs in terms of inflation. But my feeling, looking at all of the charts, is that we're going to find inflation stubborn and difficult to bring down to the sort of levels that I think the central banks would like to see inflation back to. So 2-3%, those sorts of levels are going to be very, very hard to achieve, I would suggest. I mean, looking at the US dollar index, I know you wanted to briefly cover this as well. I mean, the US dollar index has recently had that spike up to around about 115, and this is a bit of I tend to prefer to keep my charts a little bit more sort of neat and less cluttered than this, but I've tried to show the one of the reasons why we sort of targeted that 115 level. It was a sort of focal point of a lot of support and resistance lines, and when you get these support and resistance lines all sort of homing in at one particular point, price does tend to be attracted to it. So the US dollar index, reached around about 115, and historically speaking, that's a reasonable level to expect a major cyclical top. If you treat the the peak there in the early 1980s as being almost like a blow-off top, as a sort of reaction to the disbanding of the Bretton Woods Agreement and the ability of the US dollar index, or the ability of this index to kind of move freely, then what you've got there is a sort of a fairly typical sort of blow-off top, which looks to me sort of overdone in a way. And so therefore, what I'm trying to suggest here is that 115 level could well be more representative of the type of peak that we would expect to see. But regardless of that, the pullback at the moment looks a little bit overdone, and it's been very, very rapid, very, very fast. And I think most commentators would agree that, certainly looking historically at the speed of the pullback, you would expect a sizable or notable bounce to occur over the next few weeks. So at some point in this fairly near term, I'd expect the US dollar index to find a support level either around about that 103 level, or possibly lower down at, I think it's around about 97 that I've highlighted on there. So I suspect the 103 level, 103, 103 and a half, is likely to hold support, and we get a bounce off that. But the declining support line there, the black line that's sliding down, it's got a little red circle on it there, just highlighting that level around about 97. I think that's quite likely to be tested at some point over the next sort of 12 months or so. But again, the strength of the bounce and the structure of the bounce that develops, it will tell us a lot, because if it forms a sort of a bearish rising wedge pattern, then it'll be a strong indication to a technical analyst that that's likely to resolve to the downside. So the nature of the reaction when we find clear support will give some strong clues for the US dollar index. But I mean, I have to admit the US dollar index, out of all of the charts that I'm showing you, is the one that has really kind of perplexed me the most. It went far higher than I thought it was going to at this particular point in time. And the cyclical nature of the US dollar index appears somewhat, I don't know if the word broken is appropriate, but the usual cyclical nature of the US dollar index didn't behave in the usual way over the last sort of 18 months or so. So it's made it quite hard to analyze. But one thing that I can show you that does help with the analysis is when you look at the US dollar index versus inflation. That might be a bit hard to get your head around at first because DXY is an index. The number that we talk about, 97 or 100 or whatever the DXY is at any point in time, that's an index number, and it's relating the performance of the US dollar to a basket of other currencies, principally the euro and the British pound and Japanese yen and Canadian dollar and a couple of others. So it's an index, and it fluctuates between, I suppose, about 60 to the downside and 160 to the upside, very roughly speaking, historically. But if you link that to, if you compare that to inflation, so if you have a ratio chart of the US dollar index to inflation, even though the dollar index is contained between that range, if you map it against inflation, what you can spot is periods in time when the US dollar index is not able to outperform inflation over that sort of short period of time. So if inflation is outstripping the increase in the US dollar index, it tells us something. Now, what does it tell us? Well, we can look at the chart here, and very clearly when US dollar index versus inflation plunges, precious metals have a really great time. Each of those green areas that are highlighted there are periods in time. The most recent one, of course, between around about 2000 and 2011-12, where precious metals went crazy. And you can see the previous couple of periods there where precious metals did the same thing. So what we can spot on this chart is that when the US dollar index breaks down and fails to hold support and begins to drop away to the downside, when the US dollar index versus inflation drops away to the downside like that, it's a piece of evidence. It's just one piece of evidence that precious metals are going to have the wind in their sails. Precious metals are going to be favored. It's not conclusive. It's not the only piece of evidence that we need, but it is one piece of evidence. And just looking at what's happened, the US dollar index versus inflation has broken down and it's back tested an important resistance level. That red line is an important horizontal resistance level.
Why,
so
Kevin?
Why is that versus inflation?
Why is that red line so important?
Well, it's if you look at the candles, those monthly candles, and go back to the first one that touches that red line, you've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You've got about 12 candles there that either hit it from below and get rejected, or they hit it from above and get pushed up. So what those monthly candles are telling you is that there's something very specific about that horizontal level, and it acts like an invisible force. This does sound like voodoo now, doesn't it? But I'm trying to explain it in a way that people will understand. It's like an invisible force field. It's what it's equivalent to on a price chart is the volume, support, and resistance. So you get a lot of trading action going on at a particular level, and that creates these support and resistance levels, which are visible in the form of horizontal support and resistance. And I can't quite explain it on the US dollar index versus inflation chart because it's not like a company that is being traded in the normal way. But whatever forces are at play, you can see the clear breakdowns. You can see the support and resistance levels that are shown by those black lines. And just in the same way that a normal price chart would either break to the upside or break to the downside, then this chart is doing the same thing. So whatever the dynamics are that are going on in the background that are causing it to do this, you just have to accept that, try and keep an open mind and recognize what the chart is telling you. It's one small piece of evidence. I would never put all of my faith in any one chart, but when you bring together a whole lot of charts that are telling you the same sort of thing and pointing in the same direction, what it does is it increases your confidence level. It doesn't mean it never ever means in technical chart trading that you have a 100% certainty that this is going to happen or that's going to happen. But what it does do is it increases your probability of being correct, or increases your probability of having a bet on betting on the right horse, if you like.
Yeah.
So in the case of in this particular instance, if you're looking for precious metals to do well, you'll look at this chart and you say, okay, what did this chart do in the past when precious metals did well? Oh, it broke down. Okay, so if the chart's breaking down now, that's one small piece of evidence that is counting in favor of precious metals having a good time.
Can
And
I ask
that
you a quick question here, Kevin? Going over
Yeah,
to
sure.
the left to right, the price action, if you want, whatever you want to call it, going from the left of at 3.3 down to right now 0.41 is and continuing to go down. Is that due to money printing?
Well, that's a function of inflation, because the US dollar index, as I said, is always oscillating between 60 and 160. So it's kind of contained or trapped in that sort of range. So the only way this chart can, over a long period of time, move up or down is through the effects of inflation. So this is a representation of the inflationary effects
Right.
on the whole basket of currencies, because it doesn't matter whether the US dollar index is at 60 or 160, inflation is going on outside of this bubble. So the US dollar index is like a little bubble here, and it's comparing the dollar and these other currencies, a little bit like an elevator going up and down. The US dollar index goes up, it goes down, it goes up, it goes down. But outside of that bubble, outside of that sort of elevator, inflation is raging. And so inflation does its thing. And over time, this is just sinking and sinking and sinking. It's a representation of the whole basket of currencies sinking versus inflation.
Got it. Thank you.
So taking a look at the markets and the S&P. So the S&P, so in terms of where you want to be investing, do you want to be investing in precious metals? Do you want to be investing in commodities, tech stocks, all that kind of stuff? If you can spot that the S&P is in a major breakdown, then you're going to try and identify capital flows, because compared to the money that's invested in precious metals, the money that's invested in the global stock markets is enormous, absolutely enormous. So you only need a relatively small flow to come out of the S&P 500, NASDAQ, Dow Jones, global stock markets to find their way into, say, gold or silver or platinum or whatever it happens to be, to cause a huge upside reaction, because these are much smaller markets. So spotting the S&P breaking down is going to be one important part of the jigsaw puzzle here. And the S&P has broken down, of course. We've seen a significant fall from wherever it was, up around 5,000 or so, down to less than 4,000. And what we've been building out here is an expanding descending wedge pattern. And don't worry, I mean, the terminology is a bit superfluous, really. But what the point to note is that there's a very important resistance line there. You see that dotted line that is running from the top to the bottom, sort of top left to the bottom right. And each time the price of the S&P 500 has hit that, it's been rejected and moved down. And most recently, and I drew this chart, I don't know, a couple of months ago, a month or two ago, whatever it was, and we identified that next resistance level was anywhere between about 4,100 and 4,200. It had to pass through that level around 4,200 to actually start turning us bullish on the S&P 500. It hit the lower part of that range, somewhere around 4,100, and it's been falling since then. That is the expectation. The probability, as you can see on there when I put this chart out a while ago, before it began to break down, was for a higher likelihood of a downside move and a smaller probability of an upside break. So it's all about probabilities. It's not about certainties, and you always have to keep this open mind, because whatever you think is probably going to happen, you have to be alert to the fact that there's a smaller possibility that that the chart could break out in the opposite direction. So you have to spot that when it happens, so that you can close your trades, change your position, and not have to suffer through a whole load of losses. Because when you cross these important levels, it's a bit like kind of I don't know, it's a sort of knowing where the thin ice is if you're walking across a sheet of ice. by spotting these support and resistance levels, you know where the thin spots are, and if you happen to stand on one of them, you sort of sink. Or in this case, if you get through that upper resistance level, you kind of it's a bit like James Bond's ejector seat in the car. You get catapulted upwards. So it's nice to know. It's nice to know whether you're going to hit your head.
Yeah, absolutely. But this is quite a stark, if you like, or a view on the S&P 500, because when you look at it from that position that you've got it in, it does look in probability like it is breaking down at the moment. Are you able? It
has broken down. That's a bearish rising wedge there. Yeah, that smaller pattern with the solid black lines that we've just broken down from. Yeah.
So you see that this is. Do you ever put the charts out to? Because I note down there that the chart goes to, looks like where we are today, but are you able to do a chart which predicts into the future?
Yes, absolutely. And so the probability assessment for the S&P 500 is for much lower values over the coming years, really, and I'll explain that in the next chart. The stock market, the S&P versus inflation, appears to have given the fourth signal since World War One, which has on each occasion led to many years before getting back to the highs that it was previously at. You can see on the chart here that the first time it did this, it took 24 years to get back to those highs. The next time, 21 years, and more recently, and I think people forget this actually, in the early 2000s, the S&P versus inflation took 12 years to recover. So it wouldn't have been a great place to have your money during that period of time. Of course, that's if you were unlucky enough to invest at the top. I guess over a long period of time, people will invest in stages in stock markets, but nevertheless, that very long, more than decade long period, it would have been better to have your money elsewhere. And of course, where is
elsewhere, Kevin?
Where it to be? Sorry.
Where is when you say you would have been better off to have your money elsewhere? Our community out there will be screaming at the screens right now, saying, "Where do we go then? Where do we go?" Because that's really stark. And what you just said is 12 years to recover in 2002. And I think people forget that. We've got this very blinkered vision, if you like, and short-term vision. And when I see charts like this, they put the reality stick on, and you think, all right, our community out there right now is screaming and saying, well, what do we do?
Well, that period, of course, from sort of 2000, 2001, 2002 through to 2011 there, where the S&P was going nowhere versus inflation, gold, silver, commodities, they were all having a great time. So the point of using these ratio charts and these all these charts I'm showing you is so that you can weight your portfolio, and it's all about risk, proper risk management and weighting your portfolio so that you don't just have to sit. I think sometimes people, stuck in this sort of mentality where you make your investment, you keep sort of piling your money into that investment regardless. You probably don't even look at, the bottom line and how it's doing, because you've got some idea that, 20 years from now, it's going to have gone up by, 200, 300, 400% or whatever. But, first thing about that is that, you're completely missing the opportunity to rebalance your portfolio as time goes by. And why do you need to do that? Well, because of this normal business cycles, the funds will slosh around from growth stocks to to commodities, precious metals. There's a whole range of different possibilities. There's a whole world of investments out there, whether it's currency pairs that you particularly want to play when the currencies sort of currency ratios make clear sort of turns, or whether you're wanting to play tech stocks or the S&P 500, for example, is made up of many different sectors. and some of them at the moment are doing particularly well. There are some sectors within the S&P that are actually breaking out and doing well. The S&P is a better balanced index, for example, than the Nasdaq. The Nasdaq, of course, has suffered horrendously over the last few months. And for example, the Dow Jones, this is another example of just how how long you might have to wait. This is not versus inflation. This is just a straight Dow Jones index, and look at the periods of time in the past where it's gone nowhere. 25 years in the sort of 30s, 40s, and 50s. Again, in the 1960s, 70s, and 80s, it went nowhere for 17 years. And even as recently as the late 90s and the early 2000s, it went nowhere for 12 years. So, this is the value of these big picture charts. You have to zoom out sometimes and just consider, even if you're day trading or trading on shorter time frames, you want to have the wind at your back. You want to have the tide with you, because you have a much greater chance of success if you're investing in a market that is trending in the right direction. So spotting these big trends it's very, very important. You have to have the wind at your back. Talking about stocks, I mean, Amazon. This is one particular stock. You could look at Meta, you could look at a number of tech stocks, you could look at Tesla, but Amazon has pretty much fallen off a cliff here, and it's a good example.
It doesn't. Sorry to interrupt you again, Kevin. It doesn't look like it's fallen off a cliff. It looks like it's been going up and away. I mean, it's come back a little bit.
It has. But the reason it's falling off a cliff here is because it's passed through some technical levels that indicate some serious trouble. So first off, if you notice, that looks like a green cloud that sort of moves all the way from the bottom left to the top right. That's called the Ichimoku cloud. It's a Japanese technical analysis tool, and it indicates a zone of strong support for the price. And it's interesting how it correlates quite closely there with the 6-year moving average. The 6-year moving average and the 3-year moving average both offer support, and it's broken through both of those. But also at the same time as doing all of that, we've got something that's called various different names for it, actually, but an overthrow top, you could call it. These rising wedges, and you notice the wedge pattern, it's like a triangle that's getting narrower and narrower and narrower, and the price is losing momentum as it progresses its way up towards the top of that triangle, and it has one last gasp, breaks out through the top resistance line, and then it comes crashing down through the apex of the triangle. Now, that probably sounds like complete gobbledygook to most of the people that are listening, but trust me, that is a typical chart behavior, chart action that we see over and over and over again. And I'll try and explain why it does that. This triangle pattern, there's nothing clever about it. All it's doing is it's visually showing you that the price action is getting more and more contained. It's getting squished into that triangle. So if you imagine the forces pushing the price action in that triangle, the line at the bottom and the line at the top are squishing together, and the price gets squeezed out the top in one final bull market move, and then it collapses because there's no more momentum, there's no more buyers. It's the market is done, it's finished.
But surely, Kevin,
the only thing that's going to
again, taking it from, I'm not a technical analyst, and I'm sure people watching this are not technical analysts. My question to you is, Amazon is a business, right? And I kind of say to myself, well, why do the charts say it's falling off a cliff if the business is? Do you see what I guess what I'm trying to say is, why do the charts mean so much? Isn't it about the business and the profits and losses? Does that make sense?
No, it's not. It's not. So this goes back to the fundamental versus technical argument, and you can completely zone out of all of the narratives. You can completely zone out of all of the opinions, all of the discussions. And a really good example of this was the British pound versus US dollar just a little while ago, or even the Russian ruble versus the US dollar. Both of those were meant to be completely collapsed by now. If you believed the headlines, if you believed what was being talked about in the press just a few weeks ago with the British pound, our chancellor made some, the chancellor at the time made some bad decisions, or at least decisions that the market didn't like, and the British pound went on a sort of a collapse type plunge. And at that point, when it makes the headlines and everyone's talking about it, this is the contrarian thing coming in here, because by the time it makes the headlines, either for good reasons or bad reasons, that is the time, roughly speaking, where you can expect a complete turnaround. I mean, when gold is, in the headlines and your next door neighbor's buying gold and silver and your taxi driver tells you about how much you made on gold and silver, that's the time to get out. Just the same as it was with cryptocurrencies. Last year, everybody's talking about cryptocurrencies and everybody seemed to be, becoming a millionaire and, all this sort of stuff on social media. It was completely blown out of proportion. So at that point, you have to be sort of, you can sense it. You can sense that there's a sort of euphoria, and the charts are crystallizing that information. They're putting that sort of gut feeling into something more tangible. And this chart is tangible because you don't need to know any of the stories. All you need to know is that for that chart to become bullish again, it needs to get back above that moving average, and it needs to do something technically to prove to me as a scientist. I need evidence. I'm not going to, someone's going to say Amazon's a great company, they're going to turn it around, and they're going to go back to $300-400, whatever. Well, they very well might do, but until it's proven it and shown something on that chart that triggers a bullish sort of reversal, then it's all just hearsay, and it's like old wives talking. It doesn't really mean anything. It's just chatter. It's sort of gossip.
Okay.
So you can draw a line on that chart that is a resistance line. I haven't actually shown it on there, but when the price breaks through that resistance line, then it's actually telling you something meaningful, and the algorithms will pick up on that. The trading algorithms will pick up on it. The experienced traders will pick up on it, and then buying will become, it'll encourage more buying, and then, so you then get a bit of a sort of a runaway effect taking place. But until that happens, or unless that happens, then this is heading much lower, and the volume support, I'm afraid to say, is somewhere down near sort of $5 or $6. Now, I'm not saying that Amazon's going to go to $5 or $6. I'm just pointing out a fact. That's where the volume support is. You can see the volume profile on the right there, that blue and yellow histogram on the right, and that's showing you where the volume support is. And there's precious little of it until you get all the way down there.
Wow, that's telling.
Well, it's something to bear in mind, and you just have to stay unbiased. Let the chart sort of guide you. And this is what I'm talking about here when I say unbiased. This was the Bitcoin forecast that I put out in May of this year, and myself, my colleague Patrick had previously put one out last year, in fact, when Bitcoin was well above 50,000, warning people that the price was getting too far stretched from the moving average. And at this particular point here, the technical chart gave a clear and unambiguous signal. It told us, get out. So anybody that didn't get out, and we gave the initial warning at 42,000, and then it was confirmed at 36,000. So at 42,000, we said, look, you've got to get out. At 36,000, I posted this chart and said, look, this is it. If you haven't exited now, you should have done, but this is kind of your last warning. And I plotted out the orange circle, the red circle, and the grey circle as the destinations for Bitcoin. The orange circle was hit on time, on target. The red circle was hit on time, on target. We're now hovering just at the top of that grey circle. That's where we are now today. So, and I've mentioned on here that the grey circle was a lower probability outcome, and it still is. So we may have found the bottom at whatever it was, 15,000 or so, but there is still a significant possibility that Bitcoin is headed lower to sort of 12,000 or less, and we can't disregard that possibility until, again, the evidence from the chart that told us Bitcoin was going to break down, the same evidence that told us it was going to break down, when that evidence happens in reverse, and we'll spot that when that evidence happens in reverse, and we'll be able to say, okay, all clear, the bottom is clearly forming now. We've got some evidence to suggest that it's safe to start sort of, gradually scaling back in again. But it's all about risk management with things like this, because you have to You have to really carefully manage that risk, and you can't just stick a few thousand or stick 25% of your portfolio into Bitcoin just because you think it's hit the bottom. And don't forget, something that I have to mention here is that cryptocurrencies are very, very highly correlated to NASDAQ. The SPX and NASDAQ have histories that go back much further, and the history for Bitcoin is like that. It's tiny, but during its existence, cryptocurrencies and Bitcoin have had a very high correlation with the stock market, and in particular with tech stocks. So until Bitcoin can decouple from tech stocks, we have to be very, very cautious indeed because of our expectations for the stock market. Looking at Bitcoin in detail, this is the today's picture for Bitcoin, and it's got itself into a little bit of a bearish rising wedge here with a support line and a resistance line. Now that 18 to 19,000 target zone is perfectly achievable, but really it's not until we push through that area of highlighted there that includes the what we call the wake up line there. I've actually got the 200-day moving average slightly in the wrong place there. That green line should be the 200-day moving average, but I've done something with the chart that's mucked it up. But suffice to say that the 200-day moving average is somewhere around about 21,000 at the moment. And you can see the wake up line there is a little bit higher, around 22,000. So it's pushing through that 21 to 22K level that will really tell us that something different is happening here, and it's not just another sort of disappointing move that's going to end up in another sort of lower low in the future. So pushing through that 21, 22K level will actually start to tell us that something is changing in the crypto market. But if we can't do that, then our bias remains to the downside, and that's kind of supported by the Ethereum chart as well. I've kind of stuck some nice colors on here just to make it sort of nice and simple to interpret. But in very simple terms, until we get above that wake up line there and into the green zone, then really, you can envisage it in your mind. If the price just meanders through the orange and the light green zone there, it's kind of not doing anything that's going to be, you're not going to want to invest in this, are you? If it lingers, or even worse, if it goes further down into that red zone. So it has to get into that green zone, and then we've got some evidence. As soon as we get into that green area, we've got some actual chart technical evidence. And I haven't just stuck these colors on randomly. I've put them there in the zones that contain the evidence scientifically and technically that we need. And
so what this chart is saying, Kevin, is that Ethereum could be, if you like, in the danger zone until 2025. Am I reading that correctly?
It could be, yeah. I mean, you could quite easily envisage that chart taking quite a while to bottom and to form a base and to move to the upside. We can't assume just because it crosses one of those lines, and even the wake up line there, we can't assume that just because it crosses that it's going to start going vertically upwards. It might still take quite a lot of time to build out its sort of basing pattern. If you just look back at the last two cycles for cryptos, it took at least a year, 18 months for that basing process to take place. So, I know people get very excited about cryptocurrencies and expect them to go to the moon instantly, but I would just temper your expectations and be realistic. Use history as a guide, and not get too sort of caught up in the emotion of all of this. Crypto total market cap is something that guides the entire market. Of course, this is the total sum of all the money that's invested in cryptocurrencies. So it's the total market capitalization of crypto, and you can see very clearly two nice arc patterns. One which is completed on the left-hand side of the chart, and the one on the upper right of the chart is a speculation on my behalf that we're forming another arc basing pattern. And these arcs, again, they're just a way of describing the basing process that takes place. Stan Weinstein described something similar in his book about stage analysis, and Wyckoff accumulation and distribution patterns are just the same basing and topping formations, but I've described them using these arc patterns. But the wake up line there that I've highlighted in blue, that is the line that and this terminology wake up line, it just means the price has to cross that line to kind of wake up from its slumber. That's all that means. And once the price crosses that line, it's then changed its nature, it's changed its course. It's a little bit like it's a bit like having a map, you know, and you've got a map to your destination, and you can see the path. Well, you're walking along this path, and it's clearly marked, and that's where you're going. You're going, you know, towards the edge of a cliff. But then, you know, you steer off and you go onto a different path. If you didn't have a map, you wouldn't necessarily know what path you were on. And this is your map. You know, at the moment we're on a path that's going down, and it's defined by that wake-up line. As long as we're below the wake-up line, price is going down. As soon as you cross it, something different has happened. The nature of the movement has changed. The course has changed. Something fundamental has changed. So until we get above that wake-up line there, we're not interested in cryptos at all, really. So
Okay.
that's our guiding light for the crypto sector.
Okay. We're running out of
So
time, but
it's
I really want to get into gold if we could. Gold, silver.
Yep. So looking at gold, this is gold forecast 2019. Just to show everybody the power of technical analysis. Some might be skeptical. I put this chart out in 2019, and then 2 years later, down at the lower right there, you can see the chart that actually formed. And so using the technical analysis techniques that I'm talking about here allows you to see 1 year, 2 years into the future. Of course, I didn't know that Russia invading Ukraine was going to cause it to break to the upside like that. But that's the narrative that comes along. That's the story. We don't need the story. We don't need the narrative. We just need the technical analysis. The stories will fall into line. The stories come to make the chart that you already know is going to happen. So here we are with spot price of gold. So spot price of gold, nice arc pattern there. We've got a handle that formed. Look at that spike up in last year, in March of last year. That was when the invasion happened over in Ukraine, and the move up out of that handle was a false move. It shouldn't have happened. It was a headline-driven panic reaction, and I personally believe that handle that's made up of those two lines on the top right-hand corner of the arc there, I believe that handle is the pattern that was destined to play out. It just so happens that we got that false breakout, but it came all the way back down inside the handle, and it's retested the support line. It's found the edge of the arc. It's bounced off other important levels that were there at around about 1600. And there's been a very strong reaction. We're back above that breakout line now. So we've got to wait till the end of December for the close. But if we close 1780 or higher at the end of December, then there's a confirmation there that we're heading towards the highs around 1920, that sort of level, a little bit below $2,000. Excuse me. Have a drink of water.
Idea.
Too much talking. The other thing to notice on this chart is the 7-year rate of change, and it's a very useful indicator at the bottom of the gold chart. And the 7-year rate of change, that's the black line at the bottom of the chart, also has its 3-year moving average on there as well. That's the green line. And you'll notice that the 7-year rate of change, when it crossed the green line, it gave a very good buy signal for gold back in was it around about 2002. So it's giving a very, very good signal that the gold bull market was taking hold. And in 2012, actually before most people were sort of calling the end of the precious metals bull market, this indicator, the 7-year rate of change, broke down and gave us the sell signal. So it's something that is really worth taking into account. And you can see that we've had the buy signal from the 7-year rate of change crossing above its 3-year moving average, and it recently, in fact very recently in the last few weeks, touched it and bounced off it. So we have not had a sell signal. So that's an important piece of evidence. This indicator has not given us the sell signal for gold. So that's a relief, because if it had broken down, if the black line had gone below the green one there, then that would have been a fairly strong piece of evidence that it was time to get out, because gold is going much, much lower. But thankfully, it hasn't done that. And we can look a little bit deeper under the hood at gold versus, or M2 versus gold. This is the US money supply versus the price of gold. And look at what happened last time we had a big gold bull market. This chart was moving strongly to the downside. What we want is for gold to get an ever-increasing proportion of the money supply, and that means that this chart drops. If gold gets a smaller proportion of the money supply, the chart goes up. So luckily for us, we've got a bearish pattern. That's a bad pattern for this. You know, so a bearish pattern is one that resolves to the downside. We've got a bearish rising wedge, which in the world of technical analysis means we expect a downside break. And you can see on this chart, the zoomed in little box there, that's exactly what's happening at the moment. We're getting a downside break as gold outperforms the US money supply. And if this continues, it'll be very analogous to what was happening in the period 2000 to 2012. So it's yet another piece of evidence that's falling into place in favor of a long-term precious metals bull market. It's very early days yet. I have to stress that. It's a little bit too early to be absolutely certain, and this is why as well the gold to SPX ratio has to break out, Kerry, and unless the gold to SPX ratio breaks out, then we cannot declare the start of a cyclical, you know, a major precious metals bull market. Without this breaking to the upside, we can't do it. It's just not possible. So we're getting close. We're getting very close, and you can see each time this chart breaks to the upside, we get a long, strong, trending precious metals bull market. And look at the numbers there. You know, each time this chart breaks out, we get some huge moves for gold and silver. I mean, look at the last, you know, 1,000% is not unusual. I mean, gold rose around 500% from the breakout, but of course, from the bottom to the top, it was even more than that. So perfectly reasonable to expect gold to, you know, move a similar amount when it eventually breaks out. So that would, you know, take us to anywhere probably north of $12,000 gold. So
Lord,
just keep that in your mind. You know, it sounds ridiculous, it sounds crazy, but you know, it's done it more than once in the past. And also remember, you've got to factor in inflation as well. I mean, we've got no idea what inflation is going to be like over the next sort of 10 years or so that this will, you know, take place. So it sounds crazy, but I'm just putting the numbers there that we've seen in the past, and I'm pointing out what we need in order to sort of activate this target.
it's interesting, Kevin, because I can see on this chart buy gold, sell gold. So, you know, you could have done very well if you'd been following the charts, if you like, but most people don't. And so if they do want to get into the sort of the charting space and have all this information from you, you've got a subscription service. Can they do that?
Yeah, sure. Yeah, it's northstarbadcharts.com. And you know, our subscribers get all of these roadmaps, all of these sort of heads up as to what's going on with the precious metals. I mean, here's the silver roadmap, for example. So it's a complete roadmap for our members, and they're kept constantly up to date with where we're at with these things, and particularly things like the gold to silver ratio, which does actually allow you to swap between gold and silver. And without even actually having to buy gold and silver, you can actually increase the number of ounces that you hold by playing the ratio. So you can start off with, you know, 5 ounces of gold, and after 12 months you can have 7 or 8 ounces of gold, and that doesn't even rely on the gold price going up or the silver price going up. You just play the ratio chart, and you can increase the number of ounces of gold and silver that you have. So there's some quite clever stuff that you can do with the mathematics.
I find that fascinating. So I think I'm going to have to become a subscriber, because you know, that to me sounds wonderful, but I have no clue as to how that works. You guys do, because it's all in the science and it's maths, and maths was never my strong subject at school. What is this telling us about, just before we have to finish up, what's this telling us about silver? Is silver going to break to the upside, do you think? Or because it hasn't really done very much in the last, goodness, while.
Well, you can see the $28 resistance line there. We've got to move through zone 1 or zone 2 there, and the target is clearly marked, but there's a lot of time available for silver to achieve that. And I'm not going to sit here and promise that silver's going to hit sort of 37 to or 42 to $50 in the next 6 months or so. Silver's a very spiky metal, and is prone to very rapid upside moves that reverse quite quickly. So you have to hold on tight when it does decide to move. But really, we're not looking at a major change in the silver outlook until we get above that sort of area around about $28. It's kind of all noise until we get above $28. It might be quite exciting if we go up another $3 or $4, $5 from here, but it's kind of almost irrelevant. And also, Kerry, and I noticed today, which is really interesting, is that the gold miners have been outperforming gold in this move, but the silver miners have not been outperforming silver. Silver, the metal, has absolutely, run away with it here. Goodness knows what's going on in the background, but silver is massively outperforming the mining indices, SIL and SILJ, for example. Either the miners are setting themselves up for a huge move, a monstrous move, because they're so far behind the curve here, it's not even funny. And again, the technical charts are going to give us that signal if and when that happens, so our members will get the heads up as soon as that happens. And that's why we've been holding back from buying silver miners, actually, is because that breakout hasn't occurred, even though silver seems to be in a real hurry.
All righty. Have you got any more charts before we start to wrap things up?
Well, if anyone's interested in the silver to Bitcoin ratio, that's showing that silver is outperforming Bitcoin strongly, and the silver to SPX ratio is broken out. So silver is getting some further evidence versus the SPX there, which is starting to indicate capital flows towards silver. This is a global ex uranium chart. If any uranium fans out there, forming a bullish descending wedge, there does appear to be quite a bit of possible downside in the uranium sector, and silver completely outperforming uranium at the moment. But in the longer term, in the medium to longer term, uranium does look very strongly placed, and I haven't changed my view that in the longer term, uranium is going to be an incredible investment. But we've got quite a large pullback going on at the moment, and you can see the SPX versus URA chart here. It does need to break to the downside, because we need to see these capital flows going from the stock markets into uranium. If this breaks to the downside, then uranium is going to go nuts. And it does look quite bearish, this chart. It does look quite suggestive of a near-term turnaround for uranium versus the stock markets. URA versus silver, again, another piece of evidence that URA should be seeing a turnaround soon, the uranium miners, because it's finding strong support in the uranium versus silver chart as well. So I think we could be quite close to seeing that point where uranium does start to outperform silver. So all of these charts, all of these ratio charts, as I say, they're available on a daily basis at our website. So anyone that's interested, just look us up.
Okay, Kevin, that was a really, really good, interesting. If I could get you, if you don't mind, to sum it up, what would you say? And let's give us 3 or 4 points. What advice would you give people right now if we sort of were to wrap this conversation up in a bow and say, listen, here's 4 things I think people should be doing right now?
Okay, well, first thing I would suggest is being very cautious stock markets, general equities, particularly tech stocks. It does look to me as though we're seeing a cyclical change. So the second thing would be to spot those cyclical changes and spot where the money flows are going. They're moving out of stock markets and general equities, with some exceptions. Some sectors are outperforming within the SPX, for example. Precious metals have a good long-term outlook. Shorter term, a little bit more problematic. That has been the case for a while, but the long-term charts are looking very, very promising for the precious metals. That includes platinum as well. And energy, we've seen some strong moves in energy, and it makes sense that we see quite a lot of the commodity space actually having a reasonable pullback over the near term. So I think gold and precious metals are kind of taking the baton from the rest of the commodity space at the moment. They tend to sort of swap between the precious metals and commodities sector, more broadly speaking. So precious metals, yes. Uranium, not quite there yet. And general equities, I'll be very cautious. So it's a bit of a mixed bag. There's a lot of risk out there, quite a lot of systemic risk as we go forwards as well. And I think 2023 is going to be another rocky year for investors. So more important than ever to pay attention to the technical charts and not be whipsawed by the narratives that you see. And I'm afraid to say the fundamentals don't always count for for everything. It's only the price action that really matters at the end of the day. You're not going to get wealthy on fundamentals. You're only going to get wealthy on the actual price action. So it's all about beating inflation as well. If you can spot charts that are beating the inflation, beating PPI, then you're onto a winner.
Oh, well, there you have it, ladies and gentlemen. Kevin Wadsworth, who is a technical analyst. And I don't know about you, but that showed me a heck of a lot of goings on there. And it's important. But if you want to follow some of these charts on Twitter, you can go to North Star Charts and follow Kevin on Twitter. If you go to the website, you can actually subscribe, sign up, and that way you're going to get all of these charts on a constantly evolving basis and get a little bit of direction in these choppy, uncertain times. But for now, Kevin Wadsworth, an absolute pleasure to have you on Small Caps. And let's chat in the new year. In the meantime, Merry Christmas, and we'll see you in 23.
Cheers. Same to you, Kerry.